Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this mate, Mitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for. There's the disclaimer.
Excellent.
And let me share my screen. As I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read them back to me. And to give you guys a couple minutes to put those questions in, we'll take a look at the pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions.
Perfect.
So let's do pre-market report. And these are stocks trading in pre-market hours. Up top here, we have a calendar view. So you can go back in time, click on a date to see what happened on that date, on that specific date in the pre-market. Right now, we're December 5th. So far, this is what's going on from a high level. We have 292 stocks trading higher, 464 stocks trading lower in a pre-market. As far as volume goes, we have 273 million shares trading on up volume versus 112 million on down volume. And if we convert that volume to dollar value, we have $554 million worth of stock trading higher versus $1.8 billion worth of stock trading lower. So from that perspective, it looks like the sentiment in a pre-market is leaning towards the bearish side, more stocks down, and dollar value of stocks, more of them are trading lower than higher. Let's look at it from a couple more angles, and then we'll move on to the questions. So as I scroll down here, we have a list of our most active stocks in the pre-market hours, our biggest percentage gainers, and our biggest percentage decliners. Here we got 29 stocks that made our largest percentage gainers list. So to make this list, the stocks do have to meet a certain liquidity, price, volume threshold that we set. So we got 29 stocks that made our percentage gainers list, 65 made our largest percentage decliners list. That also points to a bearish sentiment, bearish bias in the pre-market trading. If we look at this list, there are small cap stocks in there, ETFs, leverage products. So this list has any security that is trading in pre-market hours that met our thresholds and it's listed on a major US exchange. It could make this list, and to narrow it down to a smaller group of stocks, we could use the filters above. If you have a watch list, you could filter by your watch list. I'm going to use this one, an ETF, drop it down. We get a list of ETFs to choose from. Let's take SPY. And when we select that, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we have 2 stocks that made our percentage gainers list. We have 4 stocks that made our percentage decliners list, our biggest percentage decliners list. So that it's a mixed bag, probably slightly more bearish, leaning towards the bearish side of things. So, well, we'll give it a couple minutes. If you have a question, I'll take it now.
Yeah, actually, we have Laurent was nice enough to come over. He had a question yesterday. He came back today.
Okay.
So we're going to work to bring Laurent over.
Okay. So you mean like he's going to come in for a live question?
Yeah, I'm trying to bring, there he is. All right. Awesome. All right, Laurent, you're coming in. Unmute. Thanks for coming over, Laurent.
Hey, Laurent, how are you?
Hello, Will. Hello, Dmitry.
Good morning.
Can you hear me fine?
Yep.
Good. So I have a question which is not directly related to Market Chameleon, but to make it clear, I wrote it down, so I'll read it to you.
Okay.
So I have an understanding of the mechanics behind retailers placing an order and its execution via platforms.
Mm-hmm.
But from the perspective of a retail options trader, like I am,
Mm-hmm.
what are the advantages and disadvantages of using trading platforms that route orders via market maker and receive payment for order flow compared to platforms that direct orders straight to the exchange without getting through the market maker? And if you let me, I'll finish with 2-3 more questions about that specific topic.
Okay.
So how different are those routings since the exchanges take prices from the market makers in their central book, as far as I understand? Aren't market makers and technological evolution the ones which led to retailers like me being able to access those markets, specifically the options market, by reducing costs and bid-ask spreads? And finally, specifically, how do these two routing strategies impact factors like execution speed, price improvement, transaction costs, and overall trading experience for individual options traders?
Okay. I mean, these are very good questions. Might have to ask you to repeat some of them as I'm doing it, but when I'll come around just so people understand the mechanics of what goes on after you enter in an options order. And when we look at the markets, I'm using SPY as an example. When we look at the markets, there are different players engaged in these markets. And on the one side, we have liquidity providers, which are market makers that are obligated to stream quotes. They have their fair value of what they think the option is worth, and they're willing to buy below that value and sell above that value, which they consider edge. And then we have people who access the market, access it, end users, let's call them. So retail investors, and it could be professional traders as well, who are not out there, providing liquidity, but, are trying to actively either take a market, or I guess you can provide liquidity by putting a limit order in. And when we look at, how orders are handled, right? So on the one side, we have these liquidity providers. We call them streaming quotes. So, when a market maker creates a bid and an offer in an option, he has an obligation to create a bid and an offer in all these options.
Yes.
Well, and right, so all the options that are listed, they have an obligation to create a bid and an offer quote. And these quotes are electronic. They're generated. You can't do it manually, right? So it's not possible to change your price, bid and offer every time the stock ticks, because when the stock ticks, the fair value or the value of the option, it's a derivative, it'll also change. So they're creating these electronic quotes, and there's some big ones like Susquehanna, Citadel, Wolverine, I think, Jane Street. Like, a lot of them are competing, and those exchanges are also, they're different exchanges. They all consolidate. They're competing too. So you got market makers on the SIBO, you got market makers on the American Stock Exchange, all those. So those are the ones that are providing liquidity, and the way they generate revenues is from buying it below their fair value, selling it above their fair value, which they considered edge. They
Yes.
try to balance their books and so forth. So the market maker, when they make these quotes, right, these bids and offers, An important thing to them is to interact with order flow that they believe is not informed, okay, or knows more information than they do, right?
Yes.
So it's a very important thing. Otherwise, they're just a target, and eventually you're going to go out of business. If somebody is more informed, then you're always on the wrong side of the trade, right? And you
Yes.
can't do that. So it's like a, it's like a casino making odds on a football game. But if somebody knows it's rigged somehow, they'll put the casino out of business.
Yep.
So it's very important for a market maker to say, okay, I'll provide this liquidity. I'm willing to buy it. I'm willing to sell it as long as the person that I'm trading against is not more informed than I am, or has some kind of knowledge or something that I don't have, which creates an unfair disadvantage for me, right?
Yes.
I can't provide the liquidity in that case. And so the trader, type cohort, that is considered non-informed, doesn't really knows the least, right, about what's going on, or has the least research or the least amount of thought into a trade. The most impulsive trades
Yes.
come from retail traders. Those are always the most impulsive. And lots of studies have been done on this, even by the SEC, where the retail trader is the most overconfident type of trader for the least amount of knowledge, because of the least amount of knowledge they know. So those are the best types of orders for a liquidity provider to interact with, right? By far.
Yes.
So these orders coming from that type of trader is considered the most profitable. Okay, which doesn't mean that the retail trader is going to be on the wrong side of the trade, because you could still be on the right side. Just like, if you go to a casino and you bet on
red,
roulette,
yes,
you might win, right?
Yeah.
So that is acceptable. Odds, those are acceptable to a market maker, as long as it's not happening because of an unfair advantage, because they have more information, or they're better at something than the market maker, right? So, and it could be also, sometimes it's more information, sometimes there's a speed advantage. It's any type of edge you shouldn't have over the market maker. So theoretically, the market maker, for providing these types of liquidity, has certain privileges from the exchange. By streaming quotes and stuff, they have certain privileges because the speed of their updates are quicker than somebody entering in through a third party. Because if you enter an order through a third party, like your broker, the speed of it getting to the marketplace is
slower,
right, a little bit slower. And it has to go through checks, through certain broker checks before it even gets sent into the marketplace, right? So your broker has to run it through certain checks, like of compliance, okay, regulatory checks. So when you're going through a broker, obviously you have a little bit of a disadvantage, I guess, if the markets are moving fast. But most of the time, you're not trying to compete on speed anyway.
No.
You're looking at an option or whatever, probably because it just looks low enough or whatever. You're not trying to, like, in microseconds, beat somebody to the punch. So what happens is that because those retail orders are desirable, it's kind of like, think of casinos, where casinos want people with, gamblers, right? People that are willing to play against the odds, right? So casinos, what they do is they give away perks. Like if the more people play, right, the more perks you will get in the casino, like free drinks, maybe tickets to a show, whatever it is, right? Because there's competition to bring those people in. And in the retail space, it's the same thing. That the retail space, there's a competition by market makers to say, send me those orders to my exchange, let's say to the SIBO or something, right? So they start paying for that order flow. They'll pay brokers, right, to say, oh, well, your customer base is the type we are looking for. So we're willing to, give you a fee, right? Payment for your orders, payment for order flow, if you send it to us first, right?
Yes.
So we want to get the first look at it. And so that is the system right now that we have in place. The payment for order flow it's very profitable to trade against uninformed orders. We'll call them uninformed. And so those are always targets. And it doesn't mean that every single retail trader is uninformed, but they can't, they don't know which account it's coming from. They just know, we want it from here, right? So most of those orders are going to be, they already know this, and it doesn't, throughout history, you could do studies, the retail trade, they're always overconfident, thinking they're right. So you have a competition for that. And
but in a certain sense, this competition between those market makers actually makes the bid-ask spread more interesting for us in the end, because if they want to compete, they'll have to lower the prices or to up their prices.
Right. So the theory is that for competition to bring it in, they're gonna they're gonna squeeze in the spread, to bring in the order flow. So you're gonna show them your best bid and best offer. There are other, advantages to, you want to be the first one to see that order. And I think the SIBO, some of them have a flash order. So even if they're not the best bid, right, if the order comes to them first, well, they could match the best bid. So even though you're not shown the best bid, by seeing that order first, it flashes, you can match it, right? So you want to capture it because it's a retail order coming. Anyway, I'll match the best bid or offer.
Yeah.
So
and this order gets communicated to the exchange I suppose live or at the end of the day, just for them to be able to like keep it transparent, right?
Wait, sorry, say that again.
This order flow will be transmitted centralized at the exchange itself. So you get all the data of what happens during the day, right? To keep it transparent. This whole system, right?
Yeah, exactly. The order is going to come into the exchange. It'll flash. So if the exchange cannot fill that order, and there is a better bidder offer way that will be able to fill, it'll send it to a different exchange too. So they are linked. All our exchanges are linked right now. So you're not going to trade through an exchange, or so let's say the exchange goes to SIBO first, and somebody wants to sell something at $5, and there's a $5 bid on the Amex, right? If everybody on the SIBO passes and says I don't want it, the SIBO will send it to the Amex to get filled. They'll say so. They're linked. So there's a linkage. And now, why would somebody want to go direct? So here's an example I gave. Maybe what you're saying is, I don't want to go to the SIBO first and then go to the Amex, because if I'm doing that, whatever, it could take us a couple milliseconds, right? Somebody else could go to the Amex before me. So this way I could just direct it right to the Amex, right? Because I know where the bid is. I just want to go and hit it, right?
Yep.
So the advantage there is that you might not lose out by going directly to the exchange where it exists. You may not miss out on it. So another advantage is by going to, the exchanges themselves have different fee structures and tier structures. And there's like a maker taker fee structure. And so some of the exchanges for posting liquidity. So let's say you have a order, right? If you have an order and you want to put a limit order in and not necessarily take out the bid or the offer, right?
Yes.
So when you put out a limit order that doesn't automatically get executed, it gets then placed on the order book, right? It's a limit order book. And that becomes part of the limit order liquidity. You're providing liquidity. You're actually you're a liquidity provider like a market maker, right? You could better the bid, better the offer, you could go below, whatever, but all of a sudden you're a liquidity provider because you're a resting order, right?
Yes.
And what some exchanges will actually pay for that order. So instead of paying a commission to get executed, you could earn a commission. Now, it all depends on your broker if they share that, right? So that some brokers will keep it, right? But there are people who trade a lot who have gone to their brokers and worked out, a scheduled, sharing or whatever. So if you're willing to just provide the liquidity and say, well, I don't care if I get posted on a SIBO or this or that, if I post it and I'm the best bid, they have to come to me first. And if they come to me first and hit me, not only am I not paying a commission, I just earned a commission, right? Like I got paid for posting that liquidity.
Yeah, because you became a maker.
You became a maker, right? But you would have to direct it to the exchange that pays you, or pays you the most. So basically, because if you put it on an exchange that doesn't pay you, then no. So for that reason, also there might be again, that it depends on your goals and stuff like that, but it could be a reason to direct it to an exchange that pays you a higher.
I understand because I'm not asking for your opinion, but I know that, for instance, I know that, let's say, a platform like Daisy Trades routes via market makers, and I think Interactive Brokers routes trades to the exchanges, if I'm not mistaken. Yeah. So I wanted to get a feel of that difference from my point of view. Yeah, the retail trader.
Right. And we're talking about options. The stocks also
options. Yes.
Right. So we're talking about the option space, that how it gets routed. So yeah, so with the options, that's now, there are also different reasons why you might want to direct it, like if you're trading complex orders and the complex, so each exchange has their own complex order book that you might want to go directly to. There are other things in there, that you might want to, like flex orders. There are different reasons you might want to go directly to the exchange.
Yes, I get the differences because I understand how both of them work and what the advantages and disadvantages are of both of them. So just wanted to clarify really the mechanics of it, just for me to understand really what's happening.
Right. Now, and another reason, another reason, an advantage, like from a retail point of view, right? Maybe you're not doing it because you want to earn a fee, right? Let's take that out of the way. But let's say you notice that on the CBOE, right? Let's say the CBOE, you see that somebody's selling a call on the bid.
Yeah.
And you're like, you know what? I'd like to buy that call on the bid as well. Right. But if it's trading on the CBOE, then your best chance is to put that order on the CBOE, right? Because that's where the order is going, if you notice it. So you want to direct it to the exchange where you see that order. And as a customer, you're going to take a priority over the market maker, actually. So if you put in a limit order, you're going to actually jump the book. So there's a very big advantage to doing that, right? Of,
Okay.
if you notice, like right here, let's say, here's a 168 bid 180 offer, and you notice, hey, on the CBOE, somebody's selling this call for 168. Maybe they have more to sell. And I see it's happening in the CBOE. Let me send my order directly to CBOE, and I will take priority over the market makers and see if I could get, my one, share. So those are like just different reasons that you may want to, go directly. If you want to go directly to the exchange, pick the exchange.
Because you get straight to the execution.
Yeah, you get straight to the execution where it's happening. You don't want to you don't want to end up like somewhere where you get placed far away from where the executions are happening or where the orders are transacting, because you may not exactly you may not get it. You want to go exactly straight to where it's trading.
But even so it works like both ways, right? Because the bid-ask spreads, let's say 20, 30 years ago, were inaccessible for retailers, and market making and algorithmic delta hedging or whatever made it made it accessible to people like us. So it plays both ways, right?
Yeah, exactly. It plays both ways. I mean, the biggest right now advantage I would say also is that, like the ones I was telling you, if you notice, like there's some trading on SIBA, I want to put out a bit, these are happening electronically, automated, this for us, for retail person, you'd have to like notice it and know to put it manually in there. So that's still,
time.
that's still at a disadvantage, but they're definitely, over time, I think that it's gotten better and better and better for retail. I don't think it's gotten worse. I think it's gotten better and better and better for executions and fees and so forth.
Yeah, sure.
I think it's that from that part, that aspect of it, it has gotten better. But I think that another thing that's maybe happened is that there is less innovation, less products, being developed, that may have given, more choices and more types of assets, because as fees come in, and as market makers, once they start, their margins are very small, the incentive to bring in and market
is limited.
Is limited, right? Exactly. So there's trade-offs, and they constantly talk about market structure and how to improve it, because part of market structure is capital formation and bringing new companies and products onto the market. So there's always that debate going on as well.
Okay. Thank you very much, Dmitry.
Yeah, no, thank you for the question, Lauren.
Very clear. Thank you.
Well, awesome job, Lauren. We're right up against the opening. Thanks as always for bringing great questions. Thanks to the Chameleon community for joining us today. Great job, Dean, as always. We did have a question actually outstanding from Jackie. I sent it to you. We can get to it tomorrow.
Okay.
Great job, buddy.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
All right. Great, everyone. Trade in peace. Have a great day. Thanks, Dee.